Hello Mouses! There's been a lot of commentary in the news of late about the legal and ethical minefield that the Facebook IPO has become, and as a result I'm seeing a lot of people ask what the problem actually is. While there are several very good videos here on YouTube that explain what an IPO or initial public offering is, there are no good ones that I have found explaining what the scandal that resulted from Facebook's IPO is all about. I'd like to address that problem today. The main issues in the Facebook IPO scandal are twofold. The first is that Nasdaq screwed up the opening of the IPO, causing it to be delayed by half an hour and causing the delay of many small investors' buy and sell orders. As a result, people were not buying and selling at the prices that they wanted, which has caused a huge loss of money for many people. However, many investors were not affected because several investment firms appear to have favoured their larger clients over the smaller ones, resulting in large client orders going through on time. There are now class action suits being put together to deal with the ramifications of this blatant favouritism. The second issue appears to be that several of the banks underwriting Facebook's IPO were aware of information that caused them to cut their estimates of Facebook's value in the middle of the IPO roadshow, which is an almost unprecedented move. The banks then passed on their information to their larger, more favoured clients, enabling them to alter their investment plans. This information was passed on verbally and was not provided to smaller investors. The result is that we saw an effective rerun of the underhanded activities investors took part in during the dot-com boom. Back then, underwriters would allocate stocks to large investors on the understanding that those investors would continue to buy stock for a while once the company was floated on the stock market. The investors would then bail out once the share price was high, leaving those who bought the shares at the inflated price to suffer the losses caused by the large share value tanking once the big investors had stopped buying. Selective disclosure of information is a violation of the Fair Disclosure Regulation, and therefore what happened with Facebook's underwriters, particularly Goldman Sachs and Morgan Stanley according to Reuters and NBC, may actually be illegal. We can therefore expect to see some form of investigation into the dealings of these companies in relation to the IPO. The stock problem was further complicated by the fact that there are now secondary markets where shares in private companies can be bought. The result of these markets is that anyone who genuinely wants to own Facebook shares rather than simply play the stock market was able to buy into Facebook through private shares before the company went public. It's worth noting that normally, without the secondary market, you would have to approach the company personally and make a deal for buying shares. But now you can do it on the markets. So these people that did that then already had the shares that they wanted before the IPO went ahead, so they weren't buying shares along with the rest of the world. Naturally, this significantly lowers demand for the shares on the day of the IPO, so share prices tanked. Okay, that's all we have time for today. I hope this explanation has been helpful. If there are any questions or comments, please leave them in the comments section below or on Facebook, Twitter or Google+. As usual, I've got all of the references for what I've been saying in the information bar below. So that's all we have time for. Don't forget to click the like button, share this with anyone who you think would like to know what the problems with this IPO actually are, and click the subscribe button so you get future videos. Until next time, I've been Kirk-Robinson, you've been watching a video, and I'll see you tomorrow.